Hi, I'm Attila Kadikoy from Levantine & Co, here to share my thoughts on the rapid developments regarding tariffs, markets and their implications for growth. Just yesterday, President Trump announced a 90-day pause on tariffs, affecting nearly all countries except China. This announcement triggered a relief rally in equities. However, before we celebrate, let's consider the broader picture and ask, where does this truly leave us now? When we look at the political backdrop, first, you may remember I mentioned in a previous video, Trump has the ability to pivot quickly, to reverse course and present retreat as a success story. The latest tariff pause serves as a perfect example. It provides him room to appear strong to his base while addressing political and market pressures. However, uncertainty persists because the end game remains unclear. Trump's decisions are made within a small circle, yet there seem to be cracks appearing within the Republican Party. Figures like Ted Cruz are starting to speak out as the broader GOP grows weary of the economic and electoral risks leading into 2026. When we look at the market reactions, the equity markets experienced a strong rally yesterday, giving some of it back today following the pause on tariffs. However, as we know, equities can be influenced swiftly by sentiment, often in an emotional manner. Therefore, the real question is, what insight are other markets providing us? Let's look at fixed income. Yesterday, we observed significant selling in US Treasuries, pushing the 10-year yields up sharply to 4.51%. This indicates that bond investors perceive risks of persistent inflation or greater growth volatility. Today, yields are around 4.31%, showing that the bounce back has been much more subdued compared to equities. Then there are commodities. Despite the equity rally, oil and copper remain weak. That suggests that underlying concerns about global demand and real economic growth haven't disappeared. If anything, they have become more pronounced. Now, when we look at the economic impact and growth, it's crucial to note that 65% of US manufacturing GDP relies on imported semi-finished goods. Tariffs, whether suspended or not, interrupt that flow. And while consumers may be resilient, the corporate sector is facing pressure, particularly those linked to the global supply chains. There remains a credible risk of technical recession, with the US GDP growth potentially declining from pre-Trump trajectory of 3% to somewhere below zero. Additionally, we are not immune globally. Weakness in commodities, cautious bond markets, and corporate earnings under pressure all indicate persistent uncertainty regarding future growth. So what comes next? So where are we heading? Yes, the recent shift may calm markets for now, but Trump's strategy still feels tactical rather than strategic. It is unclear whether tariffs are being used as leverage or as an end goal themselves. While he may pivot when necessary, the deeper issue is that policy remains unpredictable. He knows he can't afford to lose political capital as he approaches the 2026 midterms. This situation could push him towards more market-friendly actions in the coming months. However, investors should be aware that sharp shock therapy policies or rapid reversals can incur long-term credibility costs for both markets and growth. So as a conclusion, while equities experience a relief rally, the signal from bonds and commodities suggests a more cautious stance. The market continues to struggle with accurately pricing the true direction of policy and, more importantly, the growth outlook. Until there is greater clarity on both fronts, uncertainty will remain prevailing theme. For investors, this means being selective, being diversified, and most importantly, being grounded in fundamentals rather than headlines. Thank you for watching, and I look forward to seeing your comments.